Our next speaker for this morning is Lara Dalmeyer. Lara, welcome. Nice having you with us again.
Thanks for having me this morning.
Brilliant. So Lara is from ABEX Investments. She is a co-portfolio manager of the Nedgroup Investments Flexible Income Fund. So Lara, I know that the fund has basically outperformed its benchmark over all major measurement periods. I mean, without giving away all of your secrets, do you want to share a little bit about how you did that, please?
Sure. Well, sometimes it's easier to do that than others. And at the moment, local fixed income markets in particular have, I think, allowed the fund to perform very well. If you look at the contribution to return of the fund for the last year and over the last quarter, you can see just how predominantly the local asset classes feature in this performance. You can see how well the fund's performed with its floating rate exposure. You can see how well it's performed with its nominal bond exposure, and to a lesser extent, even its inflation-linked bond component. So there really have been a number of drivers that have led to us being able to beat our benchmark, and hopefully we can continue to deliver this performance going forward. But it certainly has been a conducive market for fixed income investments.
I mean, you and Phil have tended to like floaters, eh? It's nice to see them coming through quite nicely.
Yes, we like floaters. We spend a lot of our time trying to build up this floating rate component of the portfolio as much as possible. We make sure to take credit exposure that we are very comfortable with. We're very conservative on the credit portion of the fund, and we try and really build in a spread that allows us to beat our benchmark in a consistent measure. So if we can get as large a portion of the portfolio into that asset class as we can, that really is a big aim of ours.
And I've noticed the very kind of conservative nature of the way you think about investing. I mean, that's quite valuable.
Yes,
Like people don't realize until it's too late sometimes.
that's true, particularly when it comes to credit. Look, we are very much of the mindset that this is an income fund. People are using this to ultimately draw an income, and our focus is very much on the capital preservation portion of that. Yes, we try to deliver as much above our benchmark as we can, but there is the consideration of whether the risk taking that extra or trying to beat the benchmark is worth taking on. So that is an assessment that as income managers we feel you need to take extra cognizance of.
I think that's really something that's very special about the way you and Phil manage the portfolio. So
Yeah,
thanks
we
for that.
always talk about it being steady Eddie, and hopefully it will never surprise on the downside, that it will only ever deliver what we say and how it is expected to behave.
Anyway, as I said, well done on the performance numbers.
Thank you.
Good one there. So Lara, maybe just looking at some of your market views now as well, please. So, I mean, we know that US growth has been slowing. It's been, very obvious if you look at the numbers. How has this been impacting interest rate expectations, please?
Sure. So you're correct in saying that the US is slowing, and it's slowing quite quickly. Our base case is not that it's a all wheels fall off scenario, but that it is a substantial slowdown. If you look in particular where we can see the numbers starting to hurt is when it comes to the labor side of the market. If you look at the non-farm payroll data, and I've shown a chart here, you can see just how quickly those numbers have fallen off. Very dramatic. So the yellow line there is the long-term average, sitting just above 150,000 per month. And we have now reached substantially below that. You can see in the June number even being a contraction. So you're seeing the contraction on the labor side of the US, but if you look at growth forecasts across the board, they really are starting to slow down quite substantially. Naturally, markets are then anticipating interest rate cuts to support what is a slowing economy. The difficulty in the US is that inflation is not yet anywhere near target. I mean, you're still sitting with core inflation at about 3%. So everyone starts worrying, well, what's the payoff here? Does the Fed focus on growth, or does it focus on inflation? I think the narrative becomes a bit easier for the Fed when the economy is slowing as much as it is, because you can sell the narrative that weaker growth will feed into weaker inflation, and that you will see this more natural tapering down of inflation towards target as the economy slows. So I think their reaction function will be to focus more on growth than on inflation in the short term. Long term, however, we as a house do believe that certain inflationary pressures will persist, but that will more allude to the longer term behavior of the Fed than the short to medium term, where we think they will react to this weakening in the economy in the short term. So our longer term view is that rates will struggle to come down substantially, but our shorter term view is that cuts will happen a bit more aggressively than what we thought a few months ago. If you look at the market's expectations, and I've shown that in the chart on the right, that is where the market thinks rates will be at any point in time for December 25, June 26, and December 26. And you can see over the quarter just how those interest rate expectations have moved down. What's interesting, though, in the US yield curve is just how steep the curve is staying. So yes, you've got some shorter term interest rate expectations moving lower, but the steepness of the curve is staying. So that really alludes to, I think, more fiscal concerns, longer term credit concerns around the US, anchoring the long-term yields high, but you do have the shorter term yields moving a bit more in conjunction with where the market thinks the Fed will move.
I mean, we must definitely talk more about the fiscal concerns now.
Yes.
But it's just interesting how those lines have kind of dispersed further, as we've gone through time.
For sure, exactly. So if you think now exactly what the market's thinking, they're thinking another 25 in October, 25 in December, and then another 25 points twice until June next year. So essentially 4 cuts priced in until June next year. So that's quite a big cutting cycle that the market's expecting now.
Yeah, big numbers.
Yeah.
So Lara, I guess just coming back to US fiscal policy now, and fiscal dominance is something you've been talking about for a while now. How do you think the Fed's going to react? What's going to be their kind of priority? Do you think that's still going to be the case? And what do you think effect is going to be on growth? I mean, you mentioned about them prioritizing growth now. What do you think? Let's dive deeper into that a bit more.
Yeah, you're right. On the fiscal side, we very much believe the narrative that this is an era of fiscal dominance for the US, that is predominantly what's going to drive growth over the next few years, and that monetary policy has, in all likelihood, become less effective than what it used to be, that the fiscal policy is the big driver, the predominant driver of growth. And we've seen that. We've seen how these massive fiscal deficits have driven growth, extremely productively, despite monetary policy moving to exceptionally tight levels. I think the problem now is that, the US has seen 6-7% fiscal deficits, but these big numbers are now in the base. And in order to kind of get growth to keep going, yes, fiscal deficits will remain high, but there probably isn't that much additional stimulus from just keeping deficits where they are. So you probably are seeing a slowing in how much stimulus fiscal is bringing through the economy. I think there was very much the thought that the one big beautiful bill would be an additional set of fiscal, just given the size of that bill. What's it, $2.6 trillion or something ridiculous? But the reality is, again, that is largely an extension of the previous, of tax cuts that were put in place in President Trump's first term. It's not new stimulus. So yes, fiscal dominance continues to play out, and it's why we don't believe there's going to be an absolute hard crash landing. But it is, in all likelihood, the pace is slowing. Another thing that we get asked a lot about is tariffs, and perhaps that...
I actually wanted to ask you about that. I mean, is there enough revenue coming in
to kind of offset these massive fiscal deficits? And I think the jury's still out on that. What is interesting, though, is just how skeptical the market is about tariffs. adding much to improve the fiscal situation. Like I mentioned, the yield curve is still exceptionally cheap, exceptionally steep, not cheap. Well, depends how you want to look at it, but steep was the point I was getting to. And that really is showing you that markets are worried about long-term credit. So why, when you have the potential, let's say tariffs are somewhere between 15 and 20%, why, when you have the potential of $500 or $600 billion per year in tariff revenue, why is the market not more excited about that from a fiscal point of view? And why does the market not believe that that will provide bigger relief? I think that I've put up a chart here on the left-hand side, which I'll get to in a minute, but I think it explains why. First things, you can assume all things even, you'll get these massive revenue windfalls from tariffs, but there are two big unknowns. Firstly is, how does importing behavior change in response to tariffs? And I think we all know that that will be significant. We just don't know how significant yet. But secondly, and more importantly, tariffs by economic theory are meant to be currency appreciating by nature. So I think we've heard the administration say quite a lot, this is not a tax on the American consumer. That's only true if your currency appreciates when you impose tariffs. And as we know, that has not happened. The dollar has weakened very substantially. So unfortunately, it is a tax on the American consumer through both currency depreciation, but also the fact that if you look at the import prices that I've put up, those have not budged, which means that that tax is again being taken on by the end consumer. So there's that element, which I think the market is putting a lot of emphasis on, is to say, well, yes, you think you're going to be bringing in all this revenue from tariffs, but actually there's going to be a significant behavioral change in how much consumers can actually afford, because growth is slowing, disposable incomes are getting less, and this is actually just a very difficult situation for consumers to be faced with. So in all likelihood, your 500 to 600 billion is, yes, maybe going to be 200 billion, but in the context of the US fiscal deficit, it's unfortunately not enough to make a big difference. Yeah. So unfortunately, not much has changed from quarter to quarter in our view. Fiscal
despite
dominance,
all the noise.
or despite the noise, fiscal dominance remains. Yes, maybe you're not going to have that much new growth being generated from it, but now you've got monetary policy coming into the game. Maybe there's more stimulus potentially then coming from there. Yes, we actually doubt how successful monetary policy is these days compared to 20, 30 years ago. But, on the margin, there will be a bit more stimulus coming from that now. So potentially this is again just a blip in the growth numbers, but we'll have to see.
And Lara, before I let you go, I want to ask you just your views on the South African bond market, please. I mean, what our valuations look like? Is this whole inflation targeting debate messing with your models? Because the bond markets also tend to be quite kind of globally interconnected. So kind of bringing all that together in some of our previous conversations as well.
Sure. So to answer your question, yes, the new inflation target is a bit of a new consideration that we have to take into account in our models. I don't want to touch again on what we've chatted about numerous times, where we do have some concerns around the fiscal impact of the new inflation target. But I think just talking more on valuations purely, bond valuations are starting to look a little bit expensive, not completely expensive, but I would say more on the expensive side of fair. If you look at the chart that I've just popped up, if we back imply what the market is saying the South African risk premium is in the local bond market prices, you can see just how that has drifted down. And it's moved to low levels that we haven't seen since pre-COVID. Now, you can say that a bit of this drift down is more a lower forward inflationary outlook. So perhaps that model there is not 100% accurate with this new dynamic. But even so, if I think, what is the market at a risk premium that I think is fair on South Africa, it seems to me that the market is using much closer to 3% long-term inflation than 4.5%. Which means the market is now saying the SARB, not only will they be successful in targeting 3 consistently, but that it will happen quite quickly. Now, I have my doubts on both of those statements. One, whether 3 is possible, particularly given the pressures on public sector inflation. I mean, we've just seen unions demand 15% again. And secondly, how quickly that will happen. And unfortunately, you have to keep real rates high in order to keep that anchoring expectation quite low. So there is a growth impact to this as well. As it takes longer and longer, that growth cost is more and more. And I think then you have a larger fiscal impact, which then needs to clock into a higher risk premium again. So as you can hear, I have my doubts about whether it is correct or whether bond markets are perhaps a little bit too excited too quickly on this change on how quickly this change in inflation target can happen. So the way in which we've thought about it is, it's not screamingly expensive, it's maybe marginally so. So we have really marginally started to trim duration, particularly on the shorter end of the belly. So we think that maybe, while the official announcement from National Treasury is still looming, hopefully the MTBPS, but we can't be sure, there might be a little bit of curve flattening that could still happen. But in my mind, I feel like the large moves behind this is potentially behind us. So we are less bullish duration than what we have been. But having said that, the real yields that you're still earning, it's not worth to cut duration out completely. It's probably just worth being slightly more neutral on bonds at this point in time. I will say, however, the short-end inflation-linked bonds, I think, look attractive because those break-evens are so low. So you've got the market thinking that these low targets will happen quite quickly. And I think there you've got quite nice real yields, but you've also got that protection against, maybe the market surprise that this doesn't happen as quickly as what people think it could. So I think short-end inflation-linked bonds are a very nice place to be in the market at the moment.
Yeah, I mean, Lara, you've already started talking about positioning of the portfolio. I mean, maybe you can just elaborate a bit more on that. I just love how you focus on that conservative quality, liquidity of the instruments you invest in. I think that's really important and just shows how well you've done over time taking that approach.
Thank you. So there is the asset allocation of the fund. As I mentioned earlier, we put a lot of work into this floating rate component. I do again just want to highlight the cautious stance. I think if you look at the multi-asset income category, it's a very mixed bag of funds. This is a fund on the conservative end of that spectrum. When it comes to credit, we look at JSE listed names with an effective rating of single A or better. So you will never see an unlisted credit in this portfolio, and you'll never see a name that you haven't heard of before. It will be the big names that every South African knows. We don't invest in any unguaranteed SOE debt. Any SOE debt that we consider for investment has to be fully guaranteed by the government. We really stick to the vanilla when it comes to credit, and we stick with senior, because I think that's another thing that people don't always place enough emphasis on is, yes, you can like the name, but where is it in the seniority of the book? And we always look at senior debt. We, as a rule, do not invest in AT1 debt. It is only on the very, very rare occasion where we believe you are getting paid to do so, where we will invest in anything slightly subordinated to senior. So I've mentioned the floating rate component. The fixed rate component of the portfolio is now 16%. That translates into 0.6 years nominal local bond duration. As you can see, we have trimmed that down a bit. We are sitting at 12.2% in inflation-linked bonds. That only translates into 0.3 years ILB duration. That is because these are short-dated bonds. The longer end of the linker curve continues to look expensive. We see value in the shorter end of the curve. If you look at the offshore portion of the portfolio, that continues to get lower. You're still seeing decent dollar yields, short end decent dollar yields, but as I alluded to in our view of the US and where we think interest rates can go long term, we're not overly bullish on US duration. So you can see that we're very low there, only at about 0.2 years. And that is very much in the inflation protected side, given our view that we think inflation might just, rear its head again. Not that it's a target, but people have seemed to almost forget about inflation a little bit at the moment, and we think that that might rear its head again in the medium term. Property, it's a duration asset. We are a little bit underweight there. The valuations are not looking that cheap anymore. It's had a very hard run, and we think it's probably worth taking a little bit off the table on property. So again, we've really just preferred to build up that floating rate side where we know we can deliver our benchmark at quite a consistent pace, and give investors hopefully that quite durable yield that they're looking for.
Yeah, definitely. And it's always great how you're so modest about the good yields that you still get, but
Yes.
focus on talking about the quality and liquidity of the instruments in the portfolio. So
For
Lara,
sure.
thank you
Thank
very
you.
much. Always great having you with us.
Thank you. Thanks for having me.
Yeah, and look forward to the good returns going forward as well.
We hope so. Thank you.
Brilliant. Thank you.